Okay, so today I want to talk about something that comes up quite often, sometimes not even out loud, but you can kind of sense that people are like thinking like, how are you able to buy these like big and beautiful, like, lakefront beach houses? Like on some groups, on some online groups, like you see people posting things like, how are you all able to afford these type of properties? Like, some people would say things like, I'm a lowly pediatrician. And I hate that phrase because there's nothing lowly about a pediatrician, okay? But I do see the post, so I'm going to just call it out, okay? People are like, how are you guys able to afford these like properties? Now, if we haven't met, I'm Chia Gozie Fawale. I am a pediatric anesthesiologist based in the Syracuse, New York area. I love to like chat about real estate, and I love to let people know what is possible if you only knew what was possible, right? Okay, so let's kind of rewind a couple of years back. I'd heard about short-term rentals, but I kind of thought, that's for them. That's for them rich people, right? Because somehow I didn't put myself in that, that category. Anesthesiologist, yeah. I was like, yeah, that's like, no. But what? Those properties they're expensive, right? And then I learned that there were ways to buy these properties for 10% down. I was like, wait, hold up. Just hold way up. What did you say? 10%? At the time, I was buying long-term rentals, and I would be required to put down 25%. So let's put this in numbers. That meant that if I wanted to buy a property for $160,000 as a turnkey property, I would have needed to put down $40,000 to buy the $160,000 inner city duplex. I'm in Syracuse, okay? So we still have those small numbers. But I'd have been required to put down $40,000 to buy the inner city duplex that will make me $2K a month. Okay, top, bottom, 1K a piece, 2K a month. And maybe cash flow on that will probably be like maybe $400 that month. And I'll be happy. Then people will ask me like, but then $400 a month, that's like half an extra shift. Like, can't you just like work a little more and make that? And I was like, but I'm building generational wealth. And I honestly felt that way, okay? I still do, by the way. However, I was like, but wait, I take the same $40,000 and now, just by switching the type of property, I can now buy a $400,000 lakefront property that my kids can enjoy right now, my family can enjoy right now. Matter of fact, my family actually just came from out of town, and we just spent a couple of days on the lake at the properties, enjoying said properties, okay? So when I had that mindset shift, it was like, wait a minute, why am I buying the inner city properties? Like, make this math for me. Plus, by the time we had our first short-term rental, in the first year, it made $87,000 in the first year alone, and it has gone up subsequent years. One property, okay? So I like to talk about this part because many people don't know about this. They think, okay, well, the property is $400,000. That means 25% down. It's investment property. I need to put down $100,000. Oh, okay. Well, maybe I should do that next year after I paid off my student loans and after I've done these other things. And oh, by the way, I'm afraid to put down $100,000, so maybe I just shouldn't do it at all. All right. Now, how are you able to put down 10%? Now, there is a loan product called the Second Home Occupancy Loan, okay? This is basically a home loan that was put together, for those who wanted to buy vacation homes. Now, recently, though, Fannie Mae actually allows you to legally rent this out when you're not at the property, as long as you maintain control of the property. What does this mean? This means that the property cannot be tied up in the lease. This means that you have to actually be able to use the property when you decide. And as a result, having a short-term rental fits that model very well and allows you to maintain use of the property. So if you use a second home occupancy loan, you can buy the property and then operate it as a short-term rental. The second home occupancy loan also requires that you spend some time at the property. Now, listen, I don't know about you, okay? But you don't need to tell me twice that I need to spend some time at a beach house. Okay, I gotta say, you really need, you have to meet your requirements to spend time at the beach house, okay? Done, okay? Done, sold, absolutely. Don't tell me twice, because I'll do it. Now, remember, on the tax side of things, though, you can't spend too much time at the property because then it will cancel all your short-term rental requirements. So we find a nice, happy balance in between. We make the bank happy. We spend some time in the property, but we also make the IRS happy by not going over the IRS limits. Okay, and what are those limits? 10% of the time that the property is available for rent. And then there's also a cap in terms of the number of days that you spend at the property. Okay. So second home occupancy loan, that's 10% down. Now, the second home occupancy loan, however, is a fully qualifying loan, which means that you have to have good debt to income ratio. You've got to have good reserves. You've got to be, have a good credit score, be completely bankable, et cetera, et cetera. If you do not qualify for the second home occupancy loan and therefore the 10% down loan, the other option then is to now do what's called a DSCR loan. DSCR stands for debt service coverage ratio. Okay, and that basically means that by the time you factor in the property's principal, interest, taxes, and insurance, and any kind of required payments on the property, expenses on the property, then what is left over needs to be a certain ratio compared to how much your mortgage payment will have to be. Most of the lenders that I speak with make that ratio 1. So it's really not like, it's like common sense. Like you need to be able to have enough left over to pay the mortgage, period. Okay. The DSCR loan also tends to be more of an asset-based loan. In other words, they factor in more so what the property is going to make as against your personal stuff. Okay. So yes, you still want to be bankable even with the DSCR loan, but it weighs more on the property's income than it does on you. Now, how else can you finance these purchases? Remember, you can still partner with people, in LLCs. You can do basically any of the creative strategies that you can do to acquire a long-term rental, the subject tos, the, partnerships, the syndications, the private lending, if you're going to do a fix and hold type thing, or even the BRRRR strategy where you buy, rehab, rent, refinance. Those can also be done with short-term rentals. But the primary way that a lot of people use to finance their short-term rental purchase is with the second home occupancy loan. That is the most popular because it is 10% down. And when you see how much you can make from the property, it's basically like, you know what, might as well. Anyway, I hope you have found this valuable. And if you have, definitely feel free to like, share, subscribe, send it out to your friend. Let people know that you don't have to have 25%. Some people don't know, right? And I'm like, I'm a town crier. Let them know. If this just kind of blew your mind, get the word out. Share this with a friend, subscribe, and make sure you come back for the next informative, actionable video to help you get your first short-term rental property. Take care.